anytime you've been over 35 historically, your forward returns have been negative over 1, 3, 5, and 10-year periods. So the probabilities are that people are going to lose money from these levels.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Well, 2025 draws to an end in just a few weeks. What should we expect, especially in terms of the markets, in 2026? To peer into the future for us, we've got the good fortune to welcome Danielle Park back to the program. Danielle is president and portfolio manager for Venable Park Investment Council, where she manages millions for some of Canada's wealthiest families. She's also publisher of the daily financial website, jugglingdynamite.com. Danielle, thanks so much for joining us today.
My pleasure, Adam. Thank you for having me.
Oh, it's such a pleasure. I know we're going to make a lot of people happy having you back on the program, and I'm so glad that you have been able to make time for us right here at the end of 2025, because I think, as I said there in the intro, a lot of people asking, what does 2026 hold in store? Last time you were on the program, you put together a great slide presentation that you walked the audience through about how you saw the world and what your outlook was for the future. And you have done the same thing this time around. So I know people are going to have a strong interest in that. Before we just jump to the slides, if there was a word or a phrase to kind of sum up how you're looking at 2026, what would you pick?
Oh, goodness. Crazy, volatile, uncertain. I mean, things are always uncertain, and I've always kind of poked fun at people who say things like markets hate uncertainty, because I always joke, what's certain? I have no clue. We really don't know what's happening. But I think the biggest issue here has been the disconnect between the real economy and the macro picture and asset prices, because traditionally there's been a stronger correlation there, and in the last few years there just hasn't. And so, you wonder to yourself, is it pointless? Is macro assessments or analysis, no longer necessary? Is it a waste of time? Financial analysis, is that necessary? What a waste of time. We learned how to do that in all of our finance education. So the only thing that I come to there is, if it was completely irrelevant, why would big banks and institutions continue to employ whole legions of economists and analysts and talking heads to tell us all the time, what they think is coming next? And I think the reason, frankly, is they do that because if they didn't, it would look like we're just in a big gambling casino, and someone once wisely said that casinos or financial markets are casinos with better lighting. And I've recently quipped that I find most financial types to be sort of bookies, highly paid bookies, they just sort of keep taking your bets. And if it goes badly, oh, well, so sad. It's not their fault. And if it goes well, you won because they were smart or right or correct. So it's a bit of a mess. And, things like they talk about, the Santa Claus rally is coming because seasonally this is the strong time of the year. But it's true also that, the whole year has been strong, and that the spring part of the year that was supposed to be, also favorable was when we saw a big crash. So really we're upside down, down is up, back is forward, so it's very difficult to get your bearings. And I think that's why I just continually do the historical work. Because I believe that human behavior is consistent. That has been my experience in my 60 years of life, is that human behavior is consistent. And I take some comfort from books that are written, 100 years ago and 200 years ago, 50 years ago, because they speak volumes of the exact same conditions that we're experiencing today. And of course, every generation thinks that we discover things fresh and it's only us that's ever seen this. And of course, that's rarely been the case. So that's my long story to say, I wish I could see the future. I really do. I know some people confidently predict that they can. I've learned to be more humble over time about that.
Well, I appreciate the humility, and I love the fact that you do the work, and you're about to walk us through your conclusions from having done the work. I interview a lot of people, Danielle, and I will say that the people who are the most steeped in both economic history, going back hundreds of years, some cases sometimes thousands of years, and also who are the most steeped in just general history and in human psychology. And I interview lots of people that are experts in each one of those sort of different areas. They, like you, the thing that they have the most confidence in is the consistency of human behavior. So yes, the technology changes and there are cycles, and no cycle is exactly the same, but there's a lot of rhyming. But while we might be on, the umpteenth evolution of whatever technology that we're on, we're still operating on wetware 1.0 when it comes to how the human brain is wired and how human emotions work.
Yeah, absolutely. And debt. Debt is a four-letter word. It is the great elixir to add and make progress, accelerate quickly, and look like everyone's getting away with, oh my gosh, everyone's made such great progress. And then there's always a reckoning period that comes after a massive debt expansion because the chair gets knocked out from underneath and there aren't any legs there, So I think that's another major theme through human history. And it's been one that's been with us incredibly in the last 20 years through the zero interest rate environment, et cetera. And I think that's been a unique experience almost. The fact that I've never found another period where interest rates were held at zero for 15 years. Maybe it does exist, but I've never seen it in my readings. And I think that was a bit of an anomaly. But the impact of that was to magnify, not to change to a brave new world where debt no longer matters, but I think to magnify the cycles that we're moving through.
All right. So I interviewed recently James Grant of Grant's
Mhm.
Interest Rate Observer, probably one of the most respected experts alive today on interest rates. And he was making reference to David Graeber's book, Debt, the First 5,000 Years, right? So it
Yeah,
goes back through 5,000 years of history
I've read it.
in humanity's use of debt. And he said, nowhere in any of the pages of that book were zero interest rates ever mentioned, right? And
Yeah.
that's such a unique production, or, such a unique creation of the time that we live in. And I wonder, Danielle, um, if what you think in terms of your level of surprise of how disconnected the markets are from the fundamentals and how long that has persisted recently. How much of that is due to the unprecedented developments, A, in the debt markets with, ZIRP being pursued for a number of years, um, but also with just the unprecedented amounts of stimulus that were pumped into the system during COVID. They were just at levels of magnitude that honestly, before COVID, I don't think anybody really could have ever believed that we would have done, but they're at just staggering levels. And has that just distorted the system so much that it's allowed for this divorce from reality, but sort of like the Roadrunner cartoons where the coyote goes off the cliff and he's hanging there in midair and just looking down. He hasn't fallen yet, but you do know eventually gravity's going to win.
Yes, I think it was a function of the great financial crisis and the response that came from the governments and the central banks. Because, as we all know, the system was in a lot of trouble from over leverage and speculation in the late part of that cycle into 2007-8. And I think the Obama administration, I said it at the time, and I believe it in a completely nonpartisan, I don't care what party you like. The point is, they had it in their hands to make major changes to the way that the financial system operates and the speculative nature in which, Wall Street runs amok. And instead of doing that, they saw their calling as the Affordable Care Act.
Mhm.
Essentially, Obama himself has admitted that, President Obama. And at the moment, he could have made fundamental changes like they did in 30s after the crash of 29. Instead, they brought the bankers in and said, "It's okay, boys, we've got your back." And since that time, we've just seen one initiative after another, removing regulations, removing restrictions, making it easier to speculate, the whole explosion of cyber stuff, cyber, currencies, and then all of the related infrastructure. Everything that's gone on since has really been to magnify and add leverage. And so, if you ask me why, one of the things I'm not confident about at all, even though I do all the macro work and look forward into the new year, is to the degree to which this new administration, I don't have any confidence that their appetite for clamping down on anything is more than the last couple. I think it's even worse, perhaps, in their sense of just everything is fine, all is well, let it all go. I mean, the president himself has got his own crypto coins and the meme coins and things like that. So I think my greatest fear looking into 26 is to what degree will they go prop up or bail out any kind of implosion that happens. There's all this talk about who he's going to replace as the head of the FOMC. I have no doubt that he will try and find, if possible, someone who will slash rates down to zero if possible. So I worry about that, because although I know the weighted debt ultimately is deflationary, as we've seen in the last few years, if they hand out enough to consumers, like he's talking about handing out checks, not just monetary policy being extremely loose and finding a yes person, but also that they want to hand out checks to the public to buy votes again going into the midterms. And we've seen that that can have a very inflationary impact. Make things worse in the end, not save us, not prevent harm, but actually magnify and make things worse. But in the meantime, possibly kick the can even further and allow bubbles to even get greater. So that's the reality of the conditions we're in. Finding adults is tough. Finding people who want to do fiscally prudent things is tough. I don't think our system even encourages it, frankly. So there we are.
Well, I think the challenge is pretty much we have a power structure, and by power structure, I don't just mean here in the U.S., Washington, D.C. It's also the whole corporate CEO fleet and everything. It's just, in many cases, the populace. Like nobody has any appetite for austerity. And to a certain extent, everybody just wants the status quo to continue for as long as it can. And that is cobbled together by a ton of leverage, and when it starts creaking, they just put more on to try to, smooth over things. So the problem is there's very few people that are asking for the pain it will take to try to reform the system. So here's my question for you, but I guess I know your answer, which is, do you see a path of us getting to a better state without a crisis, or basically are we going to try to continue to double and triple and quintuple down on this until it just literally can't work anymore? And only then, when the breakage happens, will the discussion be, okay, well, what's a better way to do this?
I'm afraid so. I think that's the case. I think we not only had the zero interest rate environment for all those years, we also had this unwinding of prohibition against gambling. And I think that really layered over perfectly, because if like in the early 1900s and 1800s, gambling was largely illegal. Yeah, sure, it happened, but it wasn't endorsed by the state. It was done in the back room of saloons or whatever. And then actually, I was looking at the history of this because I was quite interested. In the 1930s, they brought in, well, first of all, it was betting on racetracks was allowed in the early 1900s. And then in the 30s, they brought in gambling in Nevada, sort of in response to the Depression. It was kind of like, what can we do to cheer people up and have some revenue, and they brought in gambling. And then you've had it just, it went to state-sponsored lotteries. It went to, and now we're gambling on absolutely everything.
Right, sports gambling, now there's poly market.
Individual games, like it doesn't matter. And I'm quite convinced that that pendulum will definitely need to swing back the other way, because there is such a loss to the population in terms of attention, in terms of focus on long-term pursuits that add value and, earning a living over time, when everyone's sort of thinking about how can we win. And
right.
financial
and how
markets,
can we make the quick buck win, not the investment future, but yeah.
Financial attainment, of course, has been that other layer. Now we've got whole networks that are focused on, tickers and bets and how do you play and how do you do this. So really all of these things have worked in concert to make a population that now is almost despairing of anything that's anything more than something they have to do for more than a day or a week or a month. It's just the appetite or the discipline to stick with something, to do some in-depth thought, to develop discipline and habits. That's almost, I don't know, it's extremely rare now, I think. And that's very counterproductive. And I think that's why other societies in different times have come to ban these things, because it just becomes such a debacle.
Debacle.
And I think that's where we're at now.
So we'll get to your slides in just a second here, but on this, I've observed again through all my interviews on this channel that we have really, both with carrot and stick, been training our younger generations to speculate versus investing, which is essentially what you're saying there. And there's been carrot because you get the quick buck or the dopamine hit or the financial attainment or whatever, right? But there's also the stick of like, if you're in your early 20s and you aspire to own a home and you're despairing at the unaffordability crisis we have here, you're basically telling yourself, the only way I'm going to own a home is if I get one of these lucky lottery tickets, or the crypto that shoots the moon, or I buy the meme stock that catches fire, or whatever, right? So again, we are teaching people to only focus on today and to not do the long marathon grunt work that it takes to build long-term wealth that perseveres. So you're saying all this.
Also, even the conversation around, is education even worth it anymore? I find this absolutely appalling. Is education worth it? My gosh, we need an educated population. We need people to read all sorts of books in all sorts of disciplines or study all sorts of areas to be as well-rounded and educated as they can be. But because education became, again, inflated like a bubble through all the credit abuse that was put on and all the complexity added to institutions.
Right. And some would argue, I think, validly diluted too. So the quality of the education you were getting wasn't as good, and what you were paying for it was going through the roof. Yeah.
Sure. But it's always like compared to, well, if you can win money doing this or selling people that, who needs an education? You can get rich doing this, and it doesn't pay off to do a college degree. And I think that's very dangerous. I think that's the wrong path, because we really do, again, the only thing I've learned in my life is that discipline and thought and care are worth something. And I don't know the rest of it, the betting, the winning. The problem is you can win it all and you can lose it all. There's nothing consistent or what do you call it, reliable in that approach.
Well, as you said, the financial markets, I think you think this way, are basically a casino with better lighting, right? And what are casinos, right? Well, they're the institutions that have the odds in their favor, right? Play the game over a long enough time, the house always wins, right?
Absolutely right. And like I've said this before, but gambling is one thing. I do think we have to get that genie back in the bottle. But the other thing is that when financial markets are much more dangerous, because they're put to people as if they are different from gambling. They're not gambling, they're investing. They're what you do when you're savvy with your savings, this kind of thing. That should be true. But in the condition that we currently find them, I would submit it's more like gambling and casino-based stuff, and people don't quite appreciate often the nature of that. Some people do. They figure it out and they go, "Oh, I got it. I'm not playing at that table anymore." But other people don't realize. They think it's different this cycle, and they're fully loaded on risk, and they're not appreciating that they're actually gambling to a large degree. They think they're doing something wise. And they're that much older, which of course we can get into. But this is the problems I see.
Yeah, and I was looking at my notes from the last time we talked, and one of the things that we were focused on was, which I still believe is true today, is that the retail investor has the most exposure to stocks in terms of as a percentage of their portfolio than they ever have, and definitely true for the cohort that is retired. Right. So you're saying, look, we're taking on too much risk because we're thinking more like speculators, or we're acting more like speculators, whether we know it or not, than investors. And the numbers prove it out.
That's right. And we've seen the same thing in the housing market, which we can talk about. But, that, I guess that one, I'm taking some solace I would say, because it was so evident to me that it's been so insane for the past few
Hmm.
years. And indeed, certainly in Canada, and I know America too, prices definitely have peaked and are coming down quite sharply in many areas. And so math is starting to matter again. And so, oh, okay. Eventually, debt's a four-letter word. Eventually, math matters. So,
So, let's now move to your slides. But as we do, you're reminding me it's sort of a meme online now, but it's a clip from a movie, and it's Will Ferrell from Zoolander, and he's shouting, I feel like I'm taking crazy pills because he sees the world so differently than everybody else, right? And I feel like that's kind
mhm.
of probably how you felt for a long time. And certainly I know because of having talked with you over the years, you felt that way about housing because you're just like, all the math shows that housing cannot sustain at these prices, yet it is. Well, now we're far enough along in the story where you're starting to get some relief to your sanity saying, okay, I wasn't wrong. This just took longer than I thought it could, but math is finally making sense again. That's the pro. The con is if that's proves to be true, it's not going to be a super fun ride for most people.
No, no, it's not like it's like in The Big Short when they're at the casino and they're celebrating because it's finally happening. And I think it's Pitt's character who says to the young guys, he says, "What are you doing? Don't celebrate. This is bad for people in jail. This is going to hurt a lot of people. Realm of reality. We're not in the metaverse anymore. We're actually in a place. Can you remember in 2021 when people were buying property in the metaverse with real money, like it was a real lot and stuff, and Meta
Yep.
was doubling down on rolling that out? Now, maybe that'll happen someday. Maybe we'll all be in the metaverse, but back then it made no sense, and it turned out that yeah, it wasn't a good investment. So, anyway, yeah, I looked, it was 3 months almost to the day that we talked last. So I thought I would update a few of these macro things just to see if anything's changed. The 10-year yield, of course, was about 407 when we spoke last. It's 409 today. And the point being that, this sets loan rates, interest rates for borrowing the economy, not publicly traded companies who do so at market rates, but for the banking system, for regular people, for mortgages. So the 30-year mortgage is fixed today at 625, which is not much different than it was when we spoke 3 months ago. But it's more than double it was in Jan of 2021 at the all-time low. And this is the piece that I speak about. So the mortgage rate is still about a double from Jan of 2021. And I've suggested all along that that matters. I know there was a lot of mortgages that were at less than 3% from the low rate environment, but those have been coming up. And I saw a chart recently that there's more mortgages over 6% now in America than there are less than 6%. So I think
Hmm.
we hit the tipping point there where people have been refinancing. And, I didn't buy that argument either. For a long time, people were saying, well, don't worry, they've got long-term rates at very low long-term rate, and who would worry about them in their low rate? But in the pattern of the way Americans typically do it is they refi and harvest equity out of their homes, and so that has been the habit for many years now. And that means that when they go to refi, they are in fact having to deal with the current rates. They don't get to sit in their sheltered in their pre pre-hiking rates. So that
Hmm.
matters. And it matters in Canada too, because as you know, we have typically fixed rates that are 3 or 5 years. So the fact that mortgages are today around 4%, because Canada is actually, as you know, the Bank of Canada has cut interest rates more than the Fed has. And so we've seen our whole yield curve come down more than you have in America to date. But the point is that even around 4%, which is historically not high, it's a low rate, it's still double what people were taking out during the pandemic. And that era of low rates did nothing good, I'll submit. It made it look like people were getting away with you know, buying lots of stuff with very little income, and they were. But what it ended up doing was, in fact, just inflating the price of housing, inflating the price of goods, and inflating household debt as a function of GDP, which is shown in this chart. And 74% of Canadian household debt is mortgages and about 70% in America. So this matters a ton. You know, most people have the bulk of their net worth in whatever home equity they may have,
Mhm.
and it's levered. It's a highly levered asset. So rates really matter. And as you can see there, Canada's household debt has been trending down, thank goodness. We got to 112, we're about 97% now, but we got a long way to go to get back to any kind of healthy level. And that's tough right now because our economy is very slow. So GDP is not growing very well, and the debt's just sitting there like an anvil around the neck of people. And now
Hey,
we've got,
real quick, let me just ask you one quick question. Just go back to the U.S. Treasury, or sorry, the U.S. Uh, policy, Fed policy rate there. Or sorry, this is the Treasury. Sorry, it's 10-year Treasury yield. Um, so, it's been flat now for a good while.
Mhm.
And I sort of think of this as, uh, for the Fed policy rate, everybody was talking about higher for longer, right? What are the impacts of higher for longer going to be? And we had a lot of discussion, certainly on this channel, about the lag effect and when that was going to come into play. Um, I'm looking at that sort of stuck Treasury 10-year yield there, and I'm thinking of higher for longer, right? That this is just staying high longer than most people thought because the Fed has been cutting and whatever, but it really that 10-year hasn't budged. And the longer it stays up there, the more kind of gravity it exerts on the economy and on levered consumer households and things like that. So um, I believe that's kind of part of the message of your charts here, but just correct me if I'm wrong, but it's saying that the longer we stay up here at these levels, it's just going to be slowing things even further. I also want to note, if you flip to the next slide there, that even though mortgage rates have come down, in America, it was all about survive to 25. So the Fed will Fed will come to the rescue. It'll bring rates down. That'll bring mortgage rates down, and everybody will be able to keep their nice high housing price, and the mortgage market will thaw out, and activity will come back to housing. Obviously, we're seeing less progress on bringing the mortgage rates down that you've seen in Canada. But in Canada, as rates have come down, prices have come down at the same time, right? So lower mortgage rates are not quote unquote saving the housing market. They're not keeping those elevated prices elevated. It's not enough to keep the price correction from occurring, correct?
Absolutely. And I have that as we get along here. Absolutely. Because, and that was a message I wanted to sort of share with my American readers is, buy downs are happening. So builders are buying down rates even into the threes. And yet new home sales in Canada are in the toilet. Like they're the lowest they've been in decades. It's not rebounding. And that's because price is still so such a huge multiple of income, and I get to that. So about 31% of mortgages are now up for renewal in 26, and these were the ones that were taken out, the 5-year fixed terms that were taken out at less than 2% during the pandemic. So we still have a pretty rough go. This is going to be the biggest amount of mortgages up for renewal that are going to face a potential tripling or doubling of rates depending on the credit quality of the borrower. So that's mattering. And we've been seeing that in 25, there was almost 30% of the mortgages came up for renewal. And that's what sparked a lot of resales or listings to hit the
Hmm.
market. And we've seen that a lot. But in fact, in real terms, residential sale prices are off 25% in Canada since February of 2022, 18% nominal. And here's the point that we were just referencing. The reason that even with lower rates and prices coming down, the fact is that the prices of the properties went up about 3 times faster than the average pay of workers into 2022. And that was a function, as I say, of governments intervening in the housing market, buying back mortgages, deferring payments, allowing people not to pay, slashing mortgage rates to the lowest ever in history. All that was, again, this quick, how do we avoid any pain quickly in the near term? How do we pump this all up again fast? And they did. but it didn't serve anyone. In the long run, it made it worse and us weaker, and people are continuing to struggle. So this
Well,
is
it's sorry,
the
one question on that too. So I just interviewed housing analyst Melody Wright, and she caught some heat this time around because she made a pretty bold prediction where she said that the housing correction kind of peaked to trough in the US on average. She could see being somewhere between down 38% to down 50%. When you measure it from the height to whenever the dust settles a few years from now. And you don't necessarily have to agree with that, but your chart right previous to this one showed that from the 2022 peak in Canada, prices were down already, what, 25%? And
yeah, in
it
real
seems like,
terms.
yeah, in real terms. And it seems like you expect prices to continue coming down in the
Well,
future.
I'm hoping they do. I'm a homeowner, okay? I have a dog in this hunt, but I hope they do because they became impossible and it wasted a ton of money and it's so inefficient to spend $1 million and $2 million for a house that 5 years ago you could get for half that. It just means people are in debt that much longer. They don't get to savings for retirement or education or any other reason. They're just debt slaves. And your president's latest idea of 50-year mortgages is just like the epitome of tone deaf in terms of, we don't want people in debt for 50 years. We want them to get their house paid so that they can save for retirement. So yeah, I don't know, of course, how much things could come off. I know that nationally it was off about 39% in your last downturn in 2006 to the low, and it didn't recover for years. That's the other important point, right? When these things tend to happen, real estate cycles tend to take several years from peak to trough, and prices don't recover typically for several years after that. They're often a very long cycle. And so I think we have the setup for that again. Now, again, will the Trump administration suddenly start buying up mortgages again to, artificially support the housing market? Will they, I don't know I mean, we've learned to love the bomb here. Like whatever they come up with, whatever crazy scheme, people will think, oh, great, then housing's a go again, whether it's, mean reverted enough or not. So in the US, you've come off much less, but also your inflation, your multiples of income, as I'll get to here, are much less.
They
So
weren't as
you're
crazy as Canada, but they weren't great. And I'll let you get here, but just let me ask the question I was trying to get to, which is showing that severe price decline in Canada. And again, correct me if I'm putting words in your mouth, but the likelihood that the momentum is going to continue downwards for some good while. Would your message to the US market, which again, we've seen some metros correct and some by as much as 25% if you're living in Austin or whatever. But nationally, we still haven't had a year-over-year average price decline. We might end up this year, probably will next year, but still very slight. My question for you is Canada a preview of coming attractions to the US? If I'm watching this as a US person and saying, well, the US market hasn't really dropped yet on average, we're going to be fine. Would you say, no, look to Canada?
Well, I would say that the true North Star should be household income prices as a multiple of household income.
Hmm.
So historically, about 3 to 4 times is considered max in terms of affordability. And you guys are today around 5 times. So on that, like your average home sale price, your recent data was 416,000. That's up from the lows a few years ago. But in Canada, we got to 837, which was, was like 8 to 10 times household income. I mean, bonkers, absolutely bonkers. And still, we're about 7 times the median household income of 94,000, even though things have come off as much as they have from the peak. So this gives me reason to believe that we're not done the downside in the Canadian housing market, if it's at all left to its own market forces.
Yeah.
If there's a whole bunch of intervention again to prevent this from happening, all bets are off in the short run. But in the long run, I think the weight of this will have to, at some point, it has to connect with rents. You have to be able to have a positive carry if you're going to invest in the property. So the price matters relative to the rent you can get. That got completely out of whack. As I said, people were buying properties with negative carry of 1, 2, 3,000 a month. Made no sense at all, except they thought, well, prices will go up, so it'll make sense.
Right.
And so I think you guys still have some downside work just because you're about 5 times the median household income on average. Now, some cities and places, you look at this is why, Reventure app is good for that, right? You can go in and look at a specific area, zip code, neighborhood, et cetera, and see how much is the median home sale price that's transacting, not what people are asking. Asking's different, right? People are
Right.
asking all kinds of things and the market's frozen and nothing's selling. But the ones that are transacting, now what price is that relative to the median income in that area? And that'll give you a sense of whether prices are starting to come within the realm of reality.
Okay. But it looks like in both markets, you think the likely direction is downwards. In Canada, probably still more than the US.
Yeah, well, also, which I'll get to, is the pent-up demand in listings is extraordinary, right? So we've got this number of unsold homes sitting on the market. This was as of August, the end of August. I couldn't find this chart updated more than the end of August, but you can see there we're approaching, this is American data, we're approaching the US housing peak in terms of just dead weight sitting there. And again, a lot of people have had homes for a while and home equity, and they're anchored. This is classic human behavior, anchored to the peak price that they thought of a couple of years ago, and they want to get that. So they're really starting to, condos, was a huge overbuild, as you know, in the past few years. And this is true in Canada and major centers like Toronto, near where I live. But also in America, there's this extreme supply of condos, and they're still coming on the market, by the way. Over the next year, we expect to see a significant increase in completions in this space, while sales were at 35-year lows. So I would suggest that there's quite a bit of downside still to go in the condo market in particular. But it's also interesting because people have been talking about, well, in Toronto, where the largest population of Canada lives in the Greater Toronto area, so not just Toronto proper, but all the environs sort of within an hour of there. And it's not just condos that have been extremely weak. In the latest data, it's single family homes. Which everyone said, well, they'll never come down because everyone wants a single family home. No, they've been coming down too. They've been sitting, we've got this balloon in listings, as you can see, existing home and active listings versus sales. And the ratio there is just pretty heinous. And what you're seeing is that people in both the US and Canadian and most of the markets, other than a couple, sort of Saskatchewan, Regina, and Winnipeg, they're kind of holding in there for their own reasons at the moment, but they also didn't go up as much as Ontario and British Columbia in the pandemic boom. But their numbers are looking really rough, and a lot of delistings going on. And this is the US chart, but 50% of the people are taking properties off the market, and they're saying, oh, well, my neighbors have done this recently. On my street, I've seen this, where they listed for kind of top dollar, maybe dropped the price once, then got annoyed and said, to hell with it. We'll go south for the winter, and we'll try again in the spring. I bet you the spring's going to mean February this year, because people are so anxious and there's such a huge amount of pent-up supply, and people are going to keep hoping that they can get this price that they had in their head. And then the other thing that people are doing is, in the interim, they're looking to rent, right? So again, think of all these layer on layer on layer, this parade of horribles, as people call it. But the VRBO Airbnb thing, right? That went crazy in the last few years in terms of you couldn't even get, people couldn't find a place to rent regular in major cities all around the world, because this lovely idea, which started out so great for us all, that we could go everywhere and rent places wherever you go in the world, and who needs a hotel? Well, it became such a huge percentage of the rental stock that people in regular workers couldn't. This just made it all that much worse, and the affordability metrics that much worse. And so they brought in regulations in many areas to restrict the amount of this activity that you could do, or you had to rent for a minimum of 30 days, this kind of thing. So all of a sudden, short-term demand went away, and that was artificially propping up rental income, because people could get a higher rental income stream than they could if they rented regular on a one-year lease. So that allowed people to justify paying more too, because they were like, oh, well, we're going to get this amount of rent. Well, now the reality is that the slowing economy, there's less movement in terms of travel. People are doing staycations, they're staying local. There's all these things happening at the same time that more people are feeling the weight of their real estate and saying, okay, let's just find a regular tenant. We're not renting it enough to carry. The mortgage is coming up for renewal or just did. Holy cow, payments have gone up, everything's going up. Utilities are going up, thanks data centers. Everything's going up, right? So people are thinking, okay, well, let's rent it. So again, back to how do you know if prices are at all reasonable in an area you're considering? One of the best North Stars that you have is to look at how much could you rent? How much is this type of apartment renting for in that area, relative to what would be the mortgage, principal, interest, and taxes, like carrying costs. If you were to buy it as an investment and try and rent it to someone for positive carry, can you? And in many areas, the math is still just no good at all. Like you're still negative and subsidizing, and so a lot of people are now trying to list. So we've got immigration flows slowing in Canada and America. And you've got this surge in active rental listings. So that's another telltale sign of stress.
Law of supply and demand, you get a bunch more rental units out there, well, rents are going to come down, right? Exactly. And as you said earlier, the price of a house tied to what you can rent it for. Well, if rents are going down, your home price needs to come down.
Exactly. And this is the same data for the US. And I noted recently that it's the highest vacancy rate in the data series that I was looking, and that's better for renters. So that's good. Again, keeping in mind that shelter costs are a huge component, a third to 40%, depending on what you count, of the CPI. So a lot of the inflationary impulse came courtesy of this insanity in the housing space over the past few years. So this is disinflationary, if not outright deflationary.
And sorry, are you of the mind, because I asked this question to a lot of people, are you of the mind that inflation is measured by CPI will be coming down in the next couple of years because the lagging housing data is finally catching up to the CPI equation?
Yeah, sure. I mean, it's absolutely feeding in, and it is a disinflationary or potentially deflationary impact. Now, the extent to which, as I say, policymakers go back to trying to inflate the bubble or doing all manner of crazy things to, the extent to which tariffs impact the CPI, the cost of goods. I mean, there's a lot of moving parts in there. But as far as the shelter component, I would say it's going to be continuing to do work to the downside, which is helpful. It's better for real people working in the economy. It's better for household formation. It's better for the birth rate. I mean, this is all connected, right? So that's good. It's not so good for investors who paid too much and can't now rent. Again, they were renting a negative carry before, but now their cash flow in other areas is drying up, and now prices aren't going up, so they don't know. And REITs are interesting because REITs as an investment class have basically done nothing now for many years. There's a few exceptions, but generally speaking, they haven't been good as an investment, as a sector. So Canadian rents have in fact come down nationally. And that's deflationary. But there's that Winnipeg, Manitoba is sort of the anomaly in this data set. But rents are coming down, so that's good. And I think I talked to you about China the last time, but in my mind, they are about 3 years ahead of us in this process. They also built their brains out in real estate. 80% of Chinese net worth for households is in real estate. They were making it, zero down, and state enterprises were subsidizing so everyone could get a house for nothing to try and keep the population sort of thinking that they were getting somewhere, right? But then since that bubble burst, you've had real estate deflation on top of aging demographics, which we now have in most developed economies, including our own, including China, and low immigration. So you put all these things together, and you've got this very disinflationary or outright deflationary force that's happening. And the Chinese property market is in its fifth year of decline, or going into its fifth year of decline, and still not having any signs of life. They've tried all sorts of short-term tricks. Again, how do we get people back to the gambling mindset about, seeing property as the win? And it hasn't worked because there's just too much supply. They overbuilt like crazy. The developers are going bankrupt. I mean, it's quite a mess. So I
Yeah,
think this is
just this week we got new news on that, right? With the property developer, what is it, China Vanke, if I'm pronouncing that correctly. But it's another potential sort of what was it, Evergrande.
ever. Oh, for heaven's sake!
Yeah, I think it's
Now it's
Evergrande.
left me.
Okay.
Yeah,
Yeah,
yeah.
but anyways,
Evergrande.
Evergrande.
That's it.
Yeah,
Yeah, yeah.
yeah. So
So
the hits are still coming in that space, right? It doesn't seem like it's healing. They're still having some guys, teetering on the edge of their chairs.
absolutely. And so I think, when the bubble burst at home, China, because after the great, this is all connected. After the great financial crisis, first of all, everyone thought China would be insatiable in demand into the peak in '08. Then everything burst. Then China decided to double down on real estate, and that helped pull everyone out of the great financial crisis. And then they overbuilt and overlevered. Classic. And then the bubble burst there. And now they've been scrambling to try and find new catalysts for growth. It's not easy. And they went into all kinds of alternative energy products and things, production, EVs, all that stuff. But the race to the bottom in terms of price is that they're trying to sell it all to the rest of the world. And that's their deflationary exports, right? So they've been this plays into why you guys now are why the US is looking for tariffs. It's all related to this sense that China is exporting deflation and we can't compete because they've got excess capacity and excess supply in so many things. So we see this in the price of oil, which matters a lot to Canada, right? Like it was our go-to for so long. And back in 2008, people were predicting that it would be 200 a barrel in no time when it was 148. Well, in fact, it turns out it's a demand-based consumption. And even though there was a lot of speculation and financial shenanigans going on in futures markets, et cetera, to pump up the price, when the demand cycle turned, we were left with excess capacity and supply. And we've had a struggle ever since. I mean, geopolitical conflicts, wars, even the reflation trade in China with the excess building of everything, which is very commodity intensive, we still have seen oil struggle to find a bid. And our target has been the $40 range as it was in the 2008 cycle. And indeed, I noticed JP Morgan recently came out saying they expect about a 50% decline into 2027. I don't know if that'll happen, but again, to the extent to which market forces have anything to do with what goes on in these financial markets, I think that there is still a deflationary side there. And again, if the price of oil continues to fall and the price of gas continues to fall, that's also helpful in this whole struggle to get back to a cost of living that people can afford. So it might not be great for investors in the short term if these market forces are allowed to play out, but I think it'll be healthier for rebalancing the overall market forces and for allowing households and businesses to have some reasonable input costs. Again, tariffs is a bit of a wild card in that, but to the extent to which we can have more efficiency and better cost structure, lower commodity prices would be helpful. And of course, there's a whole bunch of dynamics around that, and the special metals that we use in all the AI and special technologies. That's a wild card in this whole thing. But it's interesting that even with 7% of the CRB index is precious metals, which you know all about, have had an extremely strong run in the last year. And yet the CRB is still really range bound. It looks like a flag, like a pennant. It's just been stuck since the peak of speculation in 2022. And it really hasn't made any headway here. So the longer it kind of holds on there, again, as the economy slows, as demand cycle turns down, I think, then we have the probability of lower commodity prices in general again. And that impacts, of course, the Canadian economy. Like 75% of our exports go to America. A good portion of that is in the petrochemical side. And we are doing things like LNG ports in British Columbia to try and get energy sent to Europe and Asia and different places. But you guys have been our main customer for so long, and of course that we've seen now we've got housing's not helping. Housing was really after the bubble burst in 2008. We had some commodities renaissance into 2011, which helped Canada again with China's big overbuild in the property sector, where they were taking down something like 70% of all the world commodities at that point to try and build out their property sector, and that, as I say, ended or burst. And now we're really struggling. We doubled down on housing to try and keep the economy afloat. And for a few years there, it was literally 100% of our GDP growth was coming from overinvestment in the residential real estate sector. And now you
I
see
didn't
that,
realize it was that high.
yeah,
That's China right there.
it was tough. It was tough. It was hard to watch, because I kept saying, this isn't helping us productivity wise. This isn't helping us make anything useful. This is just bidding up. This is a casino bidding up the price of our shelters, which is costing us in the long run. And so Canada's unemployment rate has been rising. I think there's a risk here that we could see, again, housing-led downturns tend to be the deepest, longest corrections and have the worst impact on the overall economy. And considering Canada was so highly levered to it, I'm worried that we have quite a bit longer to go here in terms of our unemployment cycle. And of course, you now are starting to see that pick up in America as well, where you've got now, 54% more layoffs in the first 11 months of 25 than you had in the prior year. So I know there's been efforts, or I'm not sure if it's intentional or not, about the hiding of the NFP data and all the employment stuff being delayed and then not issued. But, we do have these alternate sources of information that are from the private sector, and they're saying, hey guys, we've got a lot of layoffs coming. This was the other thing that caught my eye here is it's the small businesses, which we know create the lion's share of jobs in the economy. And indeed, we have here them doing the most cutting, because they're looking at questions around where's the demand coming from, what areas are growth, and yes, they're all investing in AI. Depending on the survey, 80 to 90% of companies are saying they're trying to figure out a way to use AI, but only 5% of them are saying they've found any actual efficiencies or way to generate revenue. It's mostly just how do we cut overhead. And so that marries up with this chart of, well, let's cut people. We don't need as many people for all those reasons. So that's and then this chart really I thought was interesting, because of course we all know the crazy stats on, was it 70% of the free cash flow of the companies, of the AI leaders, was going into building the infrastructure of the data centers. And even so, they've now had to start borrowing a ton because they want to even ramp that up further. But in the process, you're seeing this rollover already in non-residential investment in the economy. So notwithstanding all the hyperbole and, we're going to spend even 75 more times and all this stuff, at some point, it's not driving enough. It's not keeping the business investment component of GDP afloat. It's still trending down. So that is another problematic, because, the US has the bulk of the world's data centers. And I know some of your guests have talked about many of them are sitting empty, waiting to be hooked up to power, or, so this idea of overbuilding because money is cheap or, available. And when I say that, I mean the AI companies have been borrowing in the private markets through, the asset bubble that's enabled them to have cheap financing because of their share prices and their debt. Being so inflated. So they've really got a bunch of free money and they've thrown it around like drunken sailors again, and we'll have to wait and see to the extent it's a good investment. That remains to be seen, because there's no revenue coming from any of this. So it's tricky. And
Okay,
then
so you may get there, so you can delay your answer to this question, but I'm very curious to hear if you think that the promise doesn't prove out on the timeline that Wall Street is currently assuming.
well, it
What
never does.
Okay.
Again, I think if you think about it, investing, again, is a long, multi-year process, and building infrastructure is essential, but none of it is a quick turnaround or an easy path to riches. And the other, this chart just speaks to the computer build out for the infrastructure in the 80s, and then the internet boom, which we lived through in the late 90s. Yes, that was all putting in like, cable and networks that supported us for the decades after that. But the tech-led loss cycle for jobs went on several years. Like it wasn't
Mhm.
something that just cleared in a couple of years. And I think that the AI build out, and to the extent that it replaces humans, I mean, computers did too, internet did too, but it's a messy process, and it takes time to move people around or to find them other occupations, et cetera. So I think that maybe the job loss to date may not even really be about AI. I think it's really got more to go in terms of that theme, and maybe the job losses are just as we say about uncertainty in the economy, small businesses not finding a way to profitability. And then this is interesting because the credit cycle, as I say, debt, we have to keep our eye on that because we know that households and businesses are very highly levered now. And you're starting to see, well, we know the student loan, that's policy again, right? Student loan policy was suppressed for so long, payments were deferred. That didn't do anyone favors because people went out and borrowed more thinking they didn't have to make payments, which now they're having to make. And so the defaults are really spiking on that. Same with auto loans. People bought too much vehicle on huge payments because rates were low, and now they're struggling to make those payments. Credit card defaults have delinquencies. 90 days delinquent credit cards are up now, approaching the highs we saw during the great financial crisis. So I think those are all certainly question marks. Lenders rejecting credit applications. We've seen this before. So again, people have this perception that, well, it's not a problem. People just refi, and this has been the habit of many. We'll just refi and get a bigger loan, and we'll pay off these other credit cards and these other things. But at some point, you're so levered, and maybe you've lost some income, or
Right, the banks will cut you off. Yeah.
then suddenly, when you need it the most, they're saying, oh, well, no, we're not going to approve that refi. We're not going to approve that. So then you're seeing an increase in bankruptcies and reorganizations as well, which is all part of this cycle. Again, how we restart, it's a healthy part of it, because if people have got in over their skis, they have to find a way out, or we don't have debtor prison anymore. Someone has to allow them to restart. But anyway, so this is an interesting stat as well. And then that just brings us back to this, there's a million of these charts, and everyone goes, well, valuations don't matter. They're irrelevant. Okay, they're irrelevant. But that's what they were saying about housing and rents and income ratios, and all that was irrelevant too, because housing, we didn't understand, housing only goes up. And all I'm saying is, at some point here, you've got this record price that you've paid for record assumptions of forward earnings, that once you're priced for this kind of perfection, nothing's ever perfect. Nothing ever goes ideally. No time in human life is not without surprises. That positive surprises, great, but there's always some bad things that will hit, and that's why debt is a four-letter word, because your stability is very diminished when you're highly levered, and these markets are just full of crazy speculation and products that have been rolled out, like I said, since the great financial crisis. It's just it's like I don't, dividing cancer cells or something. It's just gone ballistic in terms of the amount of levered products and things that people are doing that is really gambling, thinking it's investing. This was a good chart, just showing, we're now something, I think we're actually more like 42 capex at the moment. I haven't looked at it in the last day or two, but anytime you've been over 35 historically, your forward returns have been negative over 1, 3, 5, and 10-year periods.
Mhm.
So the probabilities are that people are going to lose money from these levels. Now, again, there could be some intervention in the next few months that might slow that down, delay it, make it worse, but not cure it, not fix it, because you have to have the clean out phase to actually fix it. And it's not just the US. I think it's very interesting. We are very fixated because the US is highly concentrated in the handful of tech companies, and the bulk of the other companies have not done nearly as well, and many are flat since 2022, since the big peak in the metaverse mania, let's call it, from 21, 22. Many companies have not made back those highs or made any progress since there. But the U.S. market's been buoyed by this handful, as you know, of the big tech. But it's also the global stock market that has been inspired to madness, because you've got it. This is a market cap of globally stocks as a percentage of global GDP, just to show that, again, we're higher than we were in the tech wreck of 2000. We're getting back to where we were in the mania of 2021, just before we had that sort of big sell-off. And the TSX, in Canada, again, I mentioned that there was this euphoria around China and commodities in the 2008 cycle, and it peaked again in the 2011 period. And then again, as China was building and demanding and gobbling up all the hard stuff they needed to do this bubble build in real estate. But since then, Canada really topped out for 15 years there, 14 years. It didn't really make any new highs. This is just the price of the shares. It was big swings and then back down, and then COVID, of course, retested. And then in the last sort of 18 months, you've really seen, inspired by the precious metals boom, has really done a lot for sentiment around the Canadian stock market again. But you've got parabolic moves. So, I just think the chances of keeping this is not good. And the downside test from here is, sort of back to where it peaked in the last couple of cycles, around the 15,000 range. And I think people will be absolutely shocked to learn that's even on the table, or a probability. Most people think they're on an elevator or an endless escalator. They don't realize that it goes the other way. Or they're willfully blind to that. This just shows the sectors in Canada. So this goes back to my point. REITs have been negative. This goes since 2022, while the property market struggles. The rest of the gains in Canada have really happened in 2025, led primarily by gold shares, which have been late cycle performers, and that's great, and good for people who have made gains. But I'm worried that they don't appreciate what's been driving the TSX. So there's a whole bunch of portfolios and ETFs and funds that are tracking the TSX, thinking it's a diversified portfolio. Actually, it's much more concentrated than America in terms of its top 10 companies and in terms of its top two sectors, which is energy and financial shares. And the two of them together, I just released some balloons. I don't know how to stop that. It happens so rarely.
Don't worry about it.
But anyway, so it just shows, again, the vulnerability of the basket. It's not that diversified. It's very concentrated now on a couple of bets, and it makes it wobbly. So this price of gold.
Sorry, can I just ask a couple quick questions here?
Yeah.
So first off, on the previous chart with the gold mining shares having done so well, is that getting caught up in the speculation, and is this a sign of just another sector partying on, or as some think, is this gold sort of finally reflecting all the detrimental things that have been going on? And so this is, I guess the big question is this sustainable for gold, or do you expect gold to eventually have a big correction like a lot of the other asset classes we've been talking about?
Yeah. So it's a very good question, because the price was flat for so long. For years, the price of gold was just sitting there, right? Or trading in a narrow range. And people would say that gold was doing well, and I would always say, compared to what, or how are we measuring that? And they would often talk about, well, in some other currency or whatever. But I'm like, yeah, but for a Canadian, or for us Americans or Canadians, how are we measuring whether it's doing well? And the argument that I always thought was strongest was it's there as a you hold that bullion as a rainy day fund, as a, if all hell breaks loose, if the banking system collapses, you can pull out your hard metals and actually have a currency. But what happened was people, as they do, they lose interest as something goes sideways or doesn't perform for a period of time. And people were sort of either forgetting about their holdings or selling them. And that was perpetuating weakness because people have very short appetites for holding unless it's going up. And then what happened is you could argue that gold shares really caught up. They finally gave back, all the returns that people are happy they've received in gold now has really happened in the last 18 months or the last 2 years, let's say, right? So you could say, well, that was paying us back for the last 15 years because we were due. And I would say, yeah, that's an argument for sure. My concern is that Wall Street being what it is and Bay Street being what it is, what you've seen is this, as soon as the public is interested, as soon as something has made a big parabolic move, you get a piling in of all these short-term focused, again, people with low tolerance for any kind of patience or time to wait for anything. And they're piling in just like they're piling into crypto, like they're piling into meme stocks, like they're piling into anything that they think they might bet and win on. And so this is why I think it makes it that much more vulnerable, because those guys are not in for the long run. They're not there to, well, they can't clip their coupons with gold, but they're there just for the bet. And if the bet starts to go the other way, I think, you're going to see selling pressure, not to mention margin pressure. And this is just, I know people think, well, relative strength doesn't matter anymore. Well, it's mattered in the past at peaks, and we've seen that the overbought condition was this extreme only at the sort of top in the 79-80 cycle when inflation was nearing 15% at that point. So I don't think this has anything to do with inflation. I think it's possibly to do, I think it started out with the US freaking everyone out by confiscating Russian assets. I think that was a legitimate catalyst for the international population to go, wow, we're kind of nervous about the way the US confiscates things. Let's have some of this alternative currency or store of value. I think that all made sense. But I worry that we've really kind of gone to the edge of sanity here again, at least in the near term. And again, it could go on further. There's absolutely no question about that. But the question is, how do you risk manage it? If you've been in this and you've made 100% in the last year, let's say, historically, that's never been something that you retain like indefinitely. There's give and go. There's take back periods, especially when things are as overbought as they are now. And of course, the same sort of thing applies with silver. And I remember I used to tell a story about Silverman from 2011, who was this person who had put all his net worth in 4 silver companies and quit his job and then was borrowing against his portfolio to build a mansion, all on leverage. And he didn't. And I said to him, when I looked at his portfolio, I said to him, why in the world have you only got 4 silver companies? Well, because those are the things that have been going up. And I said, okay, great. Why did you quit your job? Well, because I'm a full-time investor now. Okay. Why didn't you sell some to build your house? And he said, well, because it's going to go up more. And of course, what happened was the price collapsed. And I don't know what happened to Silverman, but I'm pretty sure it wasn't good. Because he was spending $4 or $5 million of his $15 million portfolio to build this house, which we had borrowed against the portfolio on margin. I mean, see, this is the problem. People really fall in love and fall asleep, and they don't realize they won a bet. They think they're investing. And that's how they get set up for a lot of pain. So I worry about this in silver as well. And this is what I was speaking of before, S&P, Bitcoin, TSX, gold. Really, everything has had this positive correlation in the past few years, kind of all up together, and then liquidation selling, and up together, and liquidation selling. And that really makes diversification tricky. And now people are talking about, well, central banks are cutting again. And I made this point before, when they started cutting the last time, because they've paused in their cutting cycle. So people think it's all different this time. But when they start cutting, it's typically in response to weakening economy and surging unemployment. So they chase the stock market all the way down. It's not, they cut and everything's saved, at least not in the near term. And that goes back to the lag effect that you and I are aware of, but has again seemed irrelevant because, this time's different. But the reality is the cutting is in response to weakness. And that's what President Trump is arguing right now, right? That the central bank's behind the wheel, too late Powell, and he's asleep at the switch, and things are getting worse because he's kept rates too high too long. The reality is that stock market typically falls as they're cutting rates. It's not a quick sort of
Yep.
lifeboat to save anything. And so I guess it's my age, Adam. I don't know if you feel this way, but my tolerance for nonsense has definitely been going down with time. And I work in a world that is nonsensical most of the time, so it gets to be a bit much. But this is just the kind of commentary that you read or see in the mainstream media or even from so-called analysts. And this was just something they put up to say, hey, don't worry, because even if the S&P goes down a lot, you can hide in the equal weight S&P where you'll not actually lose money, because look, in this last cycle, your return was positive over this period of time. And I'm looking at this chart and I'm thinking, well, you mean it lost half as much, but it still lost 21% over this period. But the commentary around it was you can be safe there. And the reality is that this is what really happened, is that it fell 36%. And that's assuming if you invested all the dividends, which most people aren't because they're paying fees and taking withdrawals. So they're not reinvesting all the dividends. So they're not dollar cost averaging as it's falling. So they typically fare even much worse. But this is what really happened. You lost about 36% of your money, and you spent years trying to get back to square. So this is the kind of thing I cheer myself up by going and finding real data, because I actually lived through it. So I remember what happened. So when someone tells me a story, I go, that's cute. But I
Right.
actually remember what happened. And this is the other thing. This was that 2000, 2002 tech bubble, because a lot of people are saying, well, it's a US tech bubble. Don't worry, international markets will be fine. It's only the tech sector, et cetera, that's a problem. No, the general markets didn't go down 80% like the NASDAQ, but they went down by half. And that's sort of been that when you get valuations like they are now, it's been a handful of times in history, but every single one of those times you had a greater than 25% decline in the stock market. And other countries went along for the ride. It's not like you can hide in islands in Europe or Asia or somewhere because of this interconnectedness. And I've shown this chart before, but it's again speaking to the notion that dividend stocks are protecting safe haven. They can be defensive to some degree. They may go down by less than the big tech names, but they are not cash good, right? Unless you have the timeline and nerves of steel and you're reinvesting the dividends, not withdrawing it in your retirement and trying to live on this pool of money. They're a rough ride. They can be a really rough ride, and it's something you have to keep in mind. Treasury yields, on the other hand, I know people love to hate treasuries, but the fact is that when they're cutting, the yields tend to fall. Now, it'll be interesting to see. I know that I've listened to some very learned people explain. Jeffrey Gundlach is one of them, where he thinks that longer yields will go up this time while they're cutting. We'll see. But historically, since 1966, whether you get a recession or not, treasury prices rally as they're cutting. So we'll see if this time is going to be different. I'm also, the wild card is whether we're going to start seeing quantitative easing start up in 26 to support the treasury market. You may well see that, in which case, they'll do buying to try and bring the long end down again. Lord knows they've done that playbook before, and they just stopped QT. So there's that. The US dollar, we watch it very closely. It's actually an asset class that we make capital gains in as Canadians, and when it goes our way. Anyway, it's in a rising channel since the great financial crisis, when everyone was talking about the demise of the dollar. So far, not. I'm not saying it can't be, a problem, or that it won't lose its dominant currency status, but it's still within the upward channel so far. And 30% of the population are now over age 55, and they own more than half of the housing market. So that's more than 1 in 5 over 55 have multiple properties. This speaks
Mhm.
to where supply can come from too, right? People think you've got to build only new houses to create supply. I would submit to you that baby boomers that have 2 and 3 properties and are now looking to sell is another way to get supply into the market. And we're starting to see that.
And sorry, but that I've talked a lot with housing analysts about this, both in theory and some are now saying it's becoming reality. You know, next 20 years, every day, the demographics are going to create 10,000 baby boomers who need to go off to the nursing home or to the cemetery. So there's going to be this relentless tsunami of supply over the next couple of decades in housing, which is not something we've really had to deal with in recent memory.
And they own the bulk of the really expensive housing. So I
Right.
really think that is, I said to you last time, I believe the real estate cycle with the demographic impulses here is a bigger story than tariffs. It doesn't get as much attention, but I think it's much more impactful for all the reasons we've talked about. And 79% of the stock market is held by people over age 55 today. They're holding these bubbles, thinking they're investing, not realizing they're putting down on the blackjack table here. And I think that will also collide with their motivation to sell real estate or downsize real estate should you get a decline in asset prices in terms of the stock market and corporate bond market. They tend to trade together. So if they start selling off in any significant way again, I think that could also intensify the urge to downsize real estate and create more supply coming into the market. And this is the youngest third of baby boomers are hitting 65 over the next 4 years. So this pig is passing through that python. We're now down to almost everybody's, in their, well, everyone's in their 60s now, and almost everybody is going to be over 65 in the next 4 years. So that's something we've never seen in our lifetime, this degree of aging in this mass, right? And them owning most of the assets, most of the housing. So the need to raise cash, lower expenses. I think these are massive themes that are really coming. We've been talking about it for 20 years or more, but it's really getting down to the short strokes now, right? So I think we're going to really be aware of this more and more. And, just that Ned Davis comment, so worth remembering. The stock market has spent 24% of its time making fresh gains in the last 120 years. Most of the time, it's just trying to make back losses. So you have to keep that in mind when you've been given a big gift in a short period of time. You need to take profit. You need to resize. You need to scale back so that you're not just still sitting at the table at 4 a.m. with a hangover and needing a toothbrush. And anyway, I always I have all these books. I've read them all. I've read a lot of popular positive books as well, believe it or not, but I don't find them as particularly helpful in this context as today. And just there's a reason that Extraordinary Popular Delusions in the Madness of Crowd has been in print since it came out 185 years ago, because it is relevant for the reasons we touched on at the outset.
All right. Well, Danielle, thank you for putting so much effort into creating this excellent chart set here. Great discussion. I got to ask you the question that I think is on most viewers' minds right now, which is, okay, Danielle, get it, made a great case here. How does one invest for this environment?
So, like I've mentioned a few times, you look at your asset allocation. Um, you know, it's very rare that people talk about this stuff, but if you have more than 5% in any one company, I suggest you should look at downsizing that.
Hmm.
That's a lot of risk for your capital. If you have more than 10% in any particular sector, I suggest that you look at paring that back. And I mean, the thing is, again, if you had 10 or 20% of your money in something that's gone up 100%, guess what? You now have a big chunk of your money in that sector. And you should look at scaling that back again, resizing it. That's very important. I also think that cash will never be a bad thing to own in this environment. And I mean liquid cash. I don't mean, private equity or the fact that private credit is coming out with funds that it's pretending are liquid now and selling them to people as a place you can park your money when the underlying assets are liquid. I mean, there's so much going on there. Anyway, cash, money market, things that are truly cash-like, and also we still have a good weight in government bonds as a one of the rare asset classes. U.S. dollars we still have as well that do
What type of
well.
duration in those bonds?
Yeah, so we have not gone very long for the reasons that I've outlined, just in terms of wild cards that can happen. But basically, in the sort of 4 to 7 year range is, I think, the
Okay.
sweet spot of the curve right now. So, yeah, that's it. It's not very sexy, but we're trying to manage through the full cycle for real life humans with finite lifespans. And we don't want to put them in the hospital with stress. And that's basically what the game is about. The Irish
Okay.
say it's a good game played slow. That's what I think of this market environment.
Um, okay. And I can understand why. So here at the end of 2025, as we're going into 2026 with the concerns you have, a lot of these are still macro concerns. In other words, the market hasn't woken up to them yet. And so, how are you dealing with the tension of, well, I don't just want to sit entirely in short-term government debt, because there's still a market to be played here, and I hate to use the word play, but there's
So
still a
I
market. There's a market that's performing here. How do you? I guess here's my question: how are you planning on de-risking in 2026 if and when the market starts to show you signs that
well,
it's
you
no
see,
longer just a happy place?
I believe you need to do this before it starts showing you signs. I mean, it crashed from February to April, and that is not a good time to be doing right sizing of your holdings. Okay. So, what you need to do is, as I say, have an asset allocation system that defines your maximum exposure to things
Hmm.
and cut that back to size. I would do it every quarter. I would look at your holdings and resize down to your target every quarter. So that means to me that now is a good time to do it. Be another good time to do it next month. Like, basically, it's an ongoing. It's like pruning a garden.
Yeah. So basically, you've got your cash allocation, which is okay. I'm not fully invested in the market. I'm making up a number, not saying you have this. I'm 40% in cash, so I'm still 60% long assets.
Other
Um,
securities. Yep.
hopefully, I have sized them so I'm not too exposed to any one of them, like you just said.
Yes.
And as they
Yep.
continue to grow, as the market continues to power higher here, great. Trim those gains back to your target
That's right.
positions on a frequent basis. And I guess just do that. Okay, so let's say you're doing that right now. Let's say the market actually starts to break. Do you have a plan for additional, like have you created a pre-plan for
Yes.
de-risking in that scenario?
Not de-risking, for buying. So
Okay.
we have, you see, it has to be this notion that you can be perpetually at all times in stuff, constantly moving, is the financial tainment's brainwashing. It's propaganda. You need to have cash stored and target buy lists so that you know when it would be valuable to you. And using some of these fundamental principles, which I know people are passe, but just as an example, as we said with real estate, if you're looking at a property and it's 3 times your household income, or you could rent it for $1,000 a month more than all your costs, it's a good valuation. So you know that in advance. You define that in advance so that when you see it, you go, I know what that is. Yes, I'll buy that. Thank you.
Right.
And you need to have done the pre-work. You can't be emotionally, reacting. You have to have done the math, done the pre-work, made your buy list, and set aside cash so that you have liquidity. So you're not forced to sell something that's falling in order to execute on your buy list.
So I'm 1,000% behind that. But there is likely to be time between the market rolling over and the great values that you want to enter in on. And if I took good notes, you're not saying this is what's going to happen, but you're saying it wouldn't shock you, given the distorted market valuations we have right now, that the S&P could get down to like 1,500. Did I hear that correctly?
Well, I have no idea, but that would be, no, I was speaking of the TSX, the 15,000 range being the top of the last few cycles
Okay,
as
that
a
was
test for
TSX.
the TSX, right?
Okay.
Which would be a 50% drop for it from where it
Okay,
is
okay,
now.
but okay,
Yeah.
so let's
Yeah.
say S&P 3,500, it's basically
Hmm.
50% down from
Sure.
here.
Yeah.
So my question is sort of, if we start experiencing uh, a rollover that you think, okay, market's down maybe 12% right now, but I think it could go down as far as 40, 50%.
Hmm.
Are you going to do anything then portfolio wise to say, I was 40% cash, but maybe I might go 60 now or something like that to just be less exposed to the downside before you're like, hey, yeah, I think there's going to be great values to buy at the end of this, but we're going to have some pain before we get there.
Well, you see, if you've been position sizing and sector sizing and cash raising in advance of this, then
Yeah.
you don't do anything just because something's gone down 10 or 15%. It has to hit your sell targets.
Yeah.
Sorry, your buy targets. If it hits your buy targets, then you already know, okay, and you might buy it and it might fall further, but you can leg in tranches as well. You can do that in halves or thirds, knowing that you're not necessarily ever going to get the bottom, but it's more like, well, this is good value. We said if it got to this level, that would present good value. That makes good investment sense. And that's why you deploy the capital, not because you think it's, dropped, like it's going to drop more. I mean, the thing is, that's completely unknowable. Like these things have become so manic that if you're just putting your finger to the wind and going, oh, it's dropped 20%, I'm going to buy it, but you haven't done any actual valuation work to know why you're going to buy it. You're just saying
Right.
because then you're just gambling. You're just betting and you might win. You're right. You might win. And people have won by buying the dip, but they don't actually know why they bought it. And they don't have a sell rule because they didn't have a buy rule, right? So this is the thing. It's something you need to construct and lay out for yourself as a roadmap before all hell starts breaking loose.
Okay. All right. Well, I totally am again 1,000% bought in on doing your preparation work in advance of this stuff and knowing, when to get back in and knowing how to, what do you say, what sort of airbag slash crash cushion you want to have before you even get in the accident. So that all
And when
totally
you
makes sense.
say knowing when to get back in, nobody knows when it's the bottom, but you say, I'm comfortable with this level of risk,
Right.
right? I've
And
done
to
the
your point, you've
math.
done the work where you've said, hey, fundamentally, I know this thing becomes a good value below this price.
Right.
Yeah.
It might go down further, but even if it does, I'm holding it for at least 5 years or whatever your defined terms are. I know this is not money I need to buy something next year or next week. This is my long-term money, and I'm happy with this income stream, this dividend rate, this whatever, the investment income that's coming off of it. Now, it gets harder with things like precious metals if there's no income. That makes it hard to have any
Right.
valuation rules around it. But again, that's when I go back to position sizing, making sure that you don't keep having more and more riding on that horse
All
because
right. Well, very well
because
said.
because that's the problem.
All right. So Danielle, so people who have both really enjoyed, well, first, people who really enjoyed your analysis here, if they want to follow you and your work between now and your next appearance on this channel, where should they go?
Jugglingdynamite.com is my daily blog. I'm at K Danielle Park on Twitter. I hope he's going to turn the name back to Twitter. And I've heard he is. And venablepark.com is the website for the company.
Okay. And then my second question was going to be to that, which is, if somebody, presumably Canadian, says, hey, I think Danielle's really got this well under control. I want someone like her managing my money. That's where they would go to learn more about your wealth management services.
Yes.
Okay, fantastic. So Danielle, when I edit this, I will put up the links to your various websites, your Twitter handle, et cetera, so folks know where to go. Folks, those links will be in the description below this video as well. I can't thank you enough, Danielle. Thanks so much for coming to the
This was
program.
a marathon. We are both exhausted. This was like a UFC fight.
A fight. I
Not
know.
a not a fight, but it was a
Yeah.
duration contest.
I felt
It
like I
was
was just drinking from a fire hose that just kept going, but I loved every minute of it, and I think the audience did too. I'm pretty sure we're going to get some comments based on your comment there, Danielle. People saying, "I wish it was twice as long."
oh,
Um,
I hope not, because
all right.
I'm ready for a sleep.
Well, I appreciate again all the work that you put in to do this, and
Yeah.
again, very much look forward to doing this for you. At some point in the first half of 2026, so you can kind of tell us, hey, is the year playing out the way that you thought it might, or if there's, as you said, there's a lot of stuff that should happen by natural market forces. Will those forces be allowed to play out, or will the interveners intervene? That's all TBD.
That's all TBD for sure.
Well, folks, please join me in thanking Danielle for putting so much obvious hard work into the preparation of her presentation here, but also for just being so generous and specific with her insights and her outlook. So please join me in thanking her by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. If you are a Canadian with some assets, I highly recommend you reach out to Danielle there at her website. If you're an American watching this and would like to get some help from a professional financial advisor about how to potentially position and prepare for a lot of what Danielle laid out for us here, if you don't already have a good professional financial advisor advising you, consider scheduling a free consultation with one of the ones that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. To schedule one of those consultations, which are totally free, just fill out the very short form at thoughtfulmoney.com, and one of the firms will be in touch with you right away. Danielle, I can't thank you enough. Like I said, just so much work that you put into this is so obvious and so valuable. Very much appreciate this. Would love to have you back in early 2026 to give us an update. And again, just can't thank you enough for all you do.
Thank you very much for having me, Adam. I appreciate it.
And everybody else, thanks so much for watching.